Risky behavior caused the SVB collapse. There is risk. It's difficult. You can end up exposing yourself to more than one set of risks if you try to avoid one set of risks. That's what happened to Silicon Valley Bank. Mark Williams, a professor of finance at Boston University and a former bank examiner for the Federal Reserve, says that Silicon Valley Bank was a very good bank until it was no longer. The problem at Silicon Valley Bank started with its success. Many of its tech company customers were making money during the early stages of the pandemic. He says that the Silicon Valley Bank was flush. Billions and billions of dollars flowed in between 2020 and 2022, as its deposit base tripled. A lot of the billions came from the bank's risky lending to startups and companies that couldn't get loans at other banks. The risks paid off. Silicon Valley Bank took all of the billions it earned from taking risks and put them into US government bonds, which are supposed to be the least risky investment. You can give the government a loan of 3 months, 1 year, 10 years, or any other amount, depending on the bond you buy. The government will pay you back at the end of the time you were on the loan. US bonds are considered to be the safest investment. The US pays back its debts. They are often called a riskless asset. The downside? Government bonds pay out very little. Not profitable, but super safe. Some bonds are more profitable than others. It makes sense that long-term bonds pay out more at the end than short-term bonds, since long-term bonds mean you agree to lend the government your money for a long time. You get more yield when you wait. Silicon Valley Bank wanted a bigger payout. That's what happened, says Leondis, who writes about bonds for the news agency. They wanted to get longer-term bonds because they felt like they would get a joke from shorter-term bonds. Risk 1, access. Those billions were now locked up for years. It wouldn't be easy to get that money in an emergency. Risk 2, interest rates. When interest rates started going up, the market value of Silicon Valley Bank's bonds went down. That's because the bank bought its government bonds before interest rates started going up. The price you get from bonds is directly tied to interest rates. When interest rates go up, the market price of older bonds goes down because new bonds pay out higher interest rates. When rates started climbing quickly, the price of Silicon Valley Bank's bonds tumbled. Risk 3, really, really rich customers. When rumors started up about the bank, customers panicked and started pulling their money out. Because they were rich individuals and companies, that meant multi-million, even multi-billion-dollar accounts cashing out all at once. Silicon Valley Bank needed a lot of cash fast. But, of course, a lot of its cash was locked up in 10-year bonds. Now it had to try and sell those now to get cash. Silicon Valley Bank tried to sell low-interest rate bonds at a time when all the new bonds were being paid out far more than they were worth. Mark Williams says that the yield on that bond would be 20 times higher. To encourage investors to think about your bond, you would have to discount it. Silicon Valley Bank took huge losses selling off its bonds, and investors panicked and withdrew their money. Williams says it was a bank run that hadn't been seen in the US since the Great Depression. Last week, $41 billion depositor dollars were pulled out by depositors in a single day. About 25% of their total deposits is that. No bank could ever survive that sort of withdrawal. The rest of Silicon Valley Bank's deposits were taken care of. Mark Williams says that people all over the country started pulling money out of smaller banks because of Silicon Valley Bank's mistakes. Smaller, regional banks are getting potentially destabilized, says Williams. Where are the investors putting their money? Williams says a lot of it is deposited into big banks that customers think are safer. A lot of people are putting their money into bonds. What do you think about the collapse of SVB? Please comment below. Thank you for visiting Free Market Economy.